It's very difficult to predict. I'd say I feel like we're at an inflection point. You got a lot of strong underlying economic data. At the same time, we're very late cycle. You got the Fed raising rates. You got tightening financial conditions. You got trade war issues. There's still a lot of liquidity out there, but as the Fed continues to tighten, as we see tightening outside of the U.S., you're going to see that liquidity come out. And I think you're not going to see this buy the dip mentality as much. And again, I thought we'd changed course a little bit earlier in the year when the market was reacting more negatively to macro issues, but now we're kind of gotten past that. But I think ultimately we are late cycle. The Fed is raising rates, and as we've heard with your previous guests, we're not likely to see that change course just because the president doesn't want them to. I think as that continues, that liquidity comes out, and you'll see more volatility.
Let's talk coal. You say you're more bearish on the broad market averages or indexes. Why do you take that position, and why do you say that you have sort of no worries on trade, that it won't affect a lot of American industries like TV producers or home builders, even though some of the components of home building, like lumber, could be affected by tariffs?
It's a great question. Well, it's a great question, Tyler, and it's a huge question. I'd say, we're not late cycle on the economy. And Buffett hearkened out on your guys' show with Diamond. He said we're in the sixth inning. The big hitters are coming to the plate. We completely agree with Buffett on that. He then went on to say, do not confuse the stock market with the economy. That is where people are wrong. So, for example, people are making the case we're late cycle on the economy, and thus maybe the stock market. We say the opposite. We're late cycle on the stock market. Why is the market not bothered by this? Because it doesn't give a damn about trade. It gives a damn about revenue growth. Used Netflix earlier this week just as a perfect example. All it comes down to is, are you growing your revenue? If the famed, glorious, financial euphoric companies in the S&P 500 grow revenue, this market's going to go higher. If that duck is cooked, we are going to have some very frustrating markets for broad indexes. Like you said, Tyler, if I'm in the home building business, yes, lumber is $6 more expensive on a $1,500 payment per month, which means it's non-meaningful to all the individuals in America that need to go buy homes at the age of, say, 30 or 32 today. And the numbers, we're up 8% year over year in homes compared to last year. That's great, but if you look at home building stocks, people treat this like we're late cycle.
David, let me turn back to you for a final thought there. Are you worried about trade or not?
Tyler, I'm more worried about what the Fed's doing. I think trade is an issue, and I think it potentially could become a bigger issue, but at this point it's more of a headline issue. I'm more worried about what the Fed is doing and the impact that removing all of this liquidity from the economy that has reached levels we've never seen before, the impact that has on the economy, the impact that has on the stock market, absolutely. Those are things that I'm worried about, and those are things that I don't know
So you kind of agree with the president there.
On.
Am I taking it one step too far?
No, I don't think the Fed clearly has a mandate to raise rates. We've got full employment. We got core PC at 2%.
Right.
Their mandate is met. They've got the green light. I'm just saying that we're coming out of an extended period of tremendous liquidity. We've never seen this before.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.